Good morning. Welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Wednesday, January 20th, 2010. It's 11:30 a.m. Eastern Standard Time in the U.S., 4:30 p.m. in London, 10:30 a.m. in Mexico City. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL Instant Mail address is CATEX-TV. 1 year ago today, Barack Obama was sworn in as President of the United States. How quickly things change. He certainly has much more gray hair than he did then. We'll now go to our main news for the day. A little bit after 6 a.m. this morning, there was a powerful new aftershock in Haiti. It was about a 6.1. You can see here it's the large blue square. It shook rubble from damaged buildings, sent people, including American Army troops, out into the street. It was the largest aftershock yet to the January 12th quake. It hit at 6:03 a.m. U.S. soldiers and tent city refugees alike raced for open ground. Clouds of dust swirled around the capital. The USGS said the quake was centered about 35 miles northwest of Port-au-Prince and about 6 miles below the surface. Last week's 7.1 quake killed over 250,000 people. It's made 1.5 million people homeless. The massive international aid effort has been struggling with logistical problems. Many Haitians are still desperate for food and water now 8 days after the quake. Italy is jumping in with both feet. Here's a picture of the Italian aircraft carrier Cavour, a fairly substantial ship for the Italian Navy. It's setting sail for Haiti this morning with 800 soldiers, a floating hospital, and 6 helicopters on board. The Cavour is going to stop in Brazil to pick up Brazilian Army medical personnel before going on to Haiti. In insurance news, the U.S. government-controlled insurer AIG is apparently in the final stages of talks to sell international life insurance subsidiary Alico to MetLife for between $14 and $15 billion U.S. The supposed deal was initially reported yesterday by the Wall Street Journal. The two sides have been in talks over Alico for months and are now negotiating final deal points, according to the Journal. The agreement could come in the next couple of weeks. The sale price is reported to be at the low end of the range that Alico might attract. The unit was valued at around $20 billion by the Union Bank of Switzerland Investment Research Group last year. The sale of Alico would mark AIG's largest single sale of an asset, as it seeks to raise money to repay the U.S. government for the bailout. One interesting point to be aware of is the current CEO of AIG is Bob Benmosh, who before he had retired had been the CEO of MetLife. The president and CEO of MetLife now is C. Robert Henriksen. There are reports that Berkshire Hathaway's reinsurance unit, General Re, has agreed to pay more than $60 million to end the U.S. investigation of its role in a fraud at AIG. Bloomberg is reporting this, citing people familiar with the matter. The U.S. inquiry focused, of course, on a 2000 transaction that prosecutors said helped AIG overstate reserves. The SEC and the Department of Justice could not be reached for comment. And in New York, prosecutors apparently plan to drop criminal charges against former insurance executives targeted by former New York Attorney General Eliot Spitzer's investigation into bid rigging and broker compensation. This is according to Business Insurance Magazine. They cite an unnamed source reporting that the New York Attorney General's office will ask the New York County Supreme Court Judge James Yates today to dismiss charges against executives dating to 2004 and 2005. It's not clear who exactly or how many will have charges dismissed. At issue, of course, is an investigation that began in 2004 when Spitzer filed a lawsuit against Marsh Mac, alleging that Marsh tried to maximize its commissions by using fake quotes to steer customers to selected insurers in exchange for hidden fees. Marsh settled with Spitzer in 2005, agreeing to pay $850 million to some 70,000 clients. The FSA, the Financial Services Authority in the UK, has changed its procedure on reinsurance portfolio transfers. The FSA is no longer offering a fast route for companies to avoid value-added tax or sales tax payments. Previously, UK insurers and reinsurers were able to secure a VAT exemption in advance of their transactions by stating why their forthcoming transfer qualified as, quote, a transfer of a going concern, which of course is exempt from VAT. Now, pre-clearance of this kind has been suspended by the FSA. Reinsurers believe that this signals a tightening of the rules by FSA after Swiss Re was ordered in October of last year to pay 2 million euros in tax to authorities in Germany for the transfer of 195 life insurance portfolios from a German subsidiary to the Swiss-based parent back in 2002. That case was decided by the European Court of Justice, which set a precedent for all European Union tax authorities. One observer said, quote, it means a transfer of going concern criteria will have to be more carefully proven. Tax authorities throughout Europe are currently thought to be analyzing previous portfolio transfers and could retrospectively request VAT if the transaction failed to meet transfer of a going concern criteria. That would be a real wallapalooza, no pun intended. Here's another wallapalooza. The U.S. Dow Jones Industrial Index in New York is down 185 points. We'll go to a word now from our sponsors.
Every day, the world wakes up and goes to work, pursuing the unique opportunities that lead the global economy forward. The complexity and close connectivity of today's global marketplace is a true modern miracle that can create unparalleled success. But it takes confidence, passion, innovation, and understanding.
Enabling opportunity.
Protecting capital.
Engineering innovation.
Investing in your future.
Ensuring continuity.
Finding the right balance.
It takes Aon.
Bermuda reinsurer Max Capital, in its 10th year of operation now, expects to see its book value for 2009 grow by up to 22%, all the way up to about $27.10 or $27.40, somewhere in that range. That's compared to $22.46 at the end of 2008. This is according to the chairman and CEO, Marty Becker. Max is also projecting that its P&C top line will grow by 5% in 2010 to approximately $1.4 billion. This is despite market conditions. For 2009, net operating income per diluted share is forecast to be around $3.40 and $3.70, implying a net operating return on average shareholders' equity of between 13.8% and 15% for the year. Those are pretty good numbers from Mr. Becker. The Insurance Insider is reporting that specialist engineering offering TSM Syndicate 1110 commenced underwriting at Lloyd's on January 1st with 53 million pounds of capacity after finally receiving Lloyd's approval to operate through turnkey agent Argenta Syndicate Management. The Electrical Contractors Association-backed syndicate expects to produce around 65 million pounds in gross written premiums in 2010, with about 50 million of that written directly on behalf of the syndicate. TSM, whose planned launch was